Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, financial markets have continued to move higher over the last couple of weeks, and we thought it'd be worthwhile just sharing with you some of our thoughts on, why we're starting to see financial markets continue to push higher when, the economies by and large, both domestic and global, are still working through a lot of the challenges that we're seeing as it relates to reopening and obviously the challenges associated with getting through COVID-19. And we just highlight this in regards to a chart that we have of the US, and a recovery tracker chart of the US. And you can see comparing where we were in the early part of the year to where we are today. And you can look at that chart and you can see on the left-hand side that by and large, very few cases clearly in January. But the broader economy was in pretty good shape. You had unemployment at multi-decade lows. We had very strong consumer behaviour. And equally, we had financial conditions that were also very prevalent to allowing for an uptick in the performance of financial markets through the early part of 2020 and beyond. The S&P 500, along with the ASX 200, reached all-time highs in the early part of the year, and financial conditions, whether it be in terms of interest rates, which were at multi-decade lows at that time, liquidity in financial markets was very high, and market volatility, the risk associated with the markets was actually very low. So it was really a perfect environment for strong financial market performance. As the worst of the COVID began to hit, not only in regards to the US, but around the world, we saw that change quite dramatically. And you can see there through the months of February and March particularly, the financial markets became very stressed, and the outlook for financial markets, akin to what we were seeing in the real economy, started to continue to converge, and that where we resulted obviously in significant sell-off, particularly in risk assets through the months of February and March. So what occurred to result in a very quick snapback in financial market performance, while the real economy continues to struggle through the worst of the pandemic as it begins to reopen, but ultimately that's going to take many months and in some instances years, depending upon the industry sector. And in our view, there was probably a couple of key reasons for it, and it's why we've seen, as I said, such a strong rebound in financial market performance. Firstly, we saw central bank intervention in a significant manner. The US Federal Reserve cut their official rate from 1.75% all the way down to 0.25%, and domestically we saw the RBA move from a cash rate of 1% down to 0.25%. Equally, central banks have been very conscious of ensuring that markets can continue to function in a normal manner. So we saw significant levels of liquidity come into financial markets, and that ultimately helped investor confidence and reduce the overall level of market volatility. Equally, central banks provided other mechanisms in terms of supporting financial markets, as well as obviously ensuring liquidity and the well functioning of those markets. In our view, that'll continue to be the case as we move through the rest of this year, and certainly in our view, we don't expect any change in the official interest rate outlook over the next 12 to 18 months. Supporting what we saw in central banks, governments around the world introduced significant fiscal packages. We saw a significant amount here locally, as we did in the US and in Europe, as well as the rest of Asia. So these two aspects combined provided a really strong backdrop to financial markets, and it wasn't so much what was occurring through the months of February and March particularly that drove that, but it was ultimately financial market participants looking forward once the recovery starts to take hold through the second half of this year. And in our view, that's where financial markets really started to focus on, just given the level of stimulus that was occurring both in regards to central banks as well as from governments on a fiscal basis. And that's why we've started to see that sharp snapback in equity markets, particularly from their March lows. Now, in our view at the moment, we probably would say that equity markets may have got a little ahead of themselves, and over the last couple of days we've clearly seen some pullback, and we wouldn't be surprised if we continue to see some level of consolidation at these current levels. But I think it does highlight that financial markets are always trying to be forward-looking relative to the rest of the economy. Ultimately, in time, you would expect them to continue to have behavioural patterns as we saw back in the early part of the year, which reflected an economic environment that was consistent with what we were seeing in regards to the outlook for financial markets. And we do believe that to be the case. Certainly as economies start to reopen, we start to see a normalisation of the way corporates can, as I said, look to deliver their goods and services, and ultimately with people moving back into their employment positions as they were previously. But that's going to take time. There's no doubt about that's going to take a significant amount of time, and we expect in many instances we'll be still seeing a number of the challenges through 2021 and beyond. But the intervention that we've been seeing, in our view, has been positive for financial markets, been positive, as I said, in terms of the positioning of portfolios, and we continue, as I said, to look through that, albeit that we think probably in some instances markets have got a little bit ahead of themselves to where the real economy is at. As always, if you have any concerns about your portfolio, please feel free to reach out to any one of our advisors, and we look forward to catching up again soon. Thanks, and bye for now.